All right, welcome DoorGrow hackers to the DoorGrow show. If you are a property management entrepreneur that wants to add doors, make a difference, increase revenue, help others, impact lives, and you are interested in growing your business and life, and you are open to doing things a bit differently, then you are a DoorGrow hacker. DoorGrow hackers love the opportunities, daily variety, unique challenges, and freedom that property management brings. Many in real estate think you're crazy for doing it. You think they're crazy for not, because you realize that property management is the ultimate high trust gateway to real estate deals, relationships, and residual income. At DoorGrow, we are on a mission to transform property management businesses and their owners. We want to transform the industry, eliminate the BS, build awareness, change perception, expand the market, and help the best property management entrepreneurs win. I'm your host, property management growth expert, Jason Hull, the founder and CEO of DoorGrow. Now, let's get into the show. And my guest today is Kim Lochridge. And Kim, welcome to the show.
Thank you, Jason. Thanks for having me.
So Kim is here with Engineered Tax Services. And we're going to be chatting a little bit today about cost segregation and how it works. And so those of you that don't really geek out on accounting, that's okay, because I pay people to help me with that stuff. I don't either, so I'm going to ask all the questions. We're going to figure this out, make sure it all makes sense. All right. So, Kim, give us a little bit of background on you and how you got started with Engineered Tax Services.
Thank you for the intro question. So I've been in with the Engineered Tax Services. I'm the executive vice president, and I've been with them for about 10 years. I started out as an associate. I was working I was on the board of a manufacturing company, and they were looking into some energy efficient tax credits, and it was just a brand new, program that had come out and tax rules, and was kind of found this company because they were doing that early on, and that was really my beginning and how I met them, and then I just came on board, and we just have been growing the company since. We started with about 5 or 6 employees, and now we have about 130 across the country. Wow. And we're doing about 150 to 200 studies a month across the country, so it's pretty impressive.
All right, and we will get into what those studies are here in just a minute. So okay. Let's get into the subject at hand. So maybe we start in the pre-show in the green room. We were chatting just a little bit because I was like, what is this stuff? And you said, well, maybe I should explain it a little bit to you, Jason. So you did, which is very gracious of you. So why don't we start with the concept of depreciation on an investment, just to make sure those that are not yet investors, or if they're just new to the space and they're just starting to deal with real estate investors, they understand this concept.
Okay, that's great. So depreciation is something that you get when you have an investment property. So when it's a tax deduction essentially. So on top of the mortgage interest or any of the expenditures that you spend on that property, you also get depreciation. Depreciation is calculated depending on the type of property that you have. But if it's a single family home or some type of residence, like a multifamily in any capacity, you're required to depreciate that property over 27 and a half years. If it's any other type of property, like an office or retail or anything commercial, then that is 39 years. Okay, so for today, I think because most everybody in the audience is more of a single family owned, we'll kind of more target the 27 and a half, but just know that that's interchangeable with 39 if it's commercial. But essentially, if you have, say, a $300,000 single family home, you're going to be able to depreciate according to the IRS. You divide that by 27 and a half, and you end up getting $10,909 every year that you can help use that to offset the income that you made on that property and then not pay tax on it. Okay. So sometimes, if it's a smaller home, that might cover it, and that and the expenses, and you won't have to pay any tax on the income, which is nice. But sometimes if your cash flow is pretty good, rents are high right now, mortgage rates are low, you might have owned it for a while, then this could be something that could help you. So if you have that is a little bit your income is more than the depreciation, then you're going to want to make sure to do something else. And this is where cost segregation comes in. Also,
Okay.
if you end up having multiple properties and one is cash flowing much more than another, then you can basically take that cash flow and you can do from one to another on, if it's in excess. And we'll kind of go over some of those details a little bit more. But
Okay.
essentially, the depreciation is just that. So you have depreciation that you're required to depreciate a building if it's on a Schedule E, or if it's a rental income. If it's a second home, you're not going to depreciate it. Okay, so it has to be a Schedule E or some sort of income revenue generating project.
And so the idea with depreciation is that everything in the property is going to depreciate at the same rate.
Yeah, everything. It's going to have the whole building, whatever you bought. So that means carpet, walls, paint, countertops, cabinets, anything that you bought in that purchase is going to be depreciated over 27 and a half years.
Right,
And
because they're all
everybody
going to
knows
last about 27 and a half years, right?
that's what the IRS says.
Okay.
But
So
it
that's not
won't.
reality. So how do we solve this problem then?
Yeah, it's not reality. And for decades, since the 40s, cost segregation as a whole, what we're going to be talking about today, has been around since the 40s, when it kind of began with court cases. And that's because property owners went and argued the fact that this is what I'm doing and this isn't really fair, because these assets that I'm depreciating over 27 and a half years or 39 years, they're not going to last that long. And I'm
Yeah.
replacing them in some cases multiple times over the course of the ownership. So I want different rules. I want to be able to depreciate those separately. But it makes it very difficult for a CPA to say how much is the carpet or how much is the building when you just bought the building. You didn't put it in. You don't have receipts. You don't know how much the roof and the HVAC and the water heater and all that were. So they can't break it down, right? A CPA doesn't have the ability to do that. So the IRS came back, and over years of morphing cost segregation, they said, we're going to give you, the ability to do cost segregation, which means that you have to have a building professional or an engineer, somebody who understands property and tax laws, come in the building and segment, hence the segregation, segment out each of the component of your building. And then as a result of segmenting those out, you can then depreciate them in different time zones or different buckets. Okay.
Okay.
So giving, for instance, and these are just some examples, and depending on the purpose of some of those components, carpeting is always going to land in a 5-year bucket. So you're going to be able to depreciate all of your carpet in 5 years, not 27 and a half.
Nice.
Things like all of your landscaping, your driveways, curbing, gutter, landscape, bushes, trees, all of rock walls, fences, all of that stuff gets to be depreciated over 15 years. That's more realistic, right? Things are going to be overgrown. You're going to have to rip things out. You're going to have to replace fences, all those types of things. So they
Okay.
give you that bucket as well. But the law also says that you can break down certain components like mechanical, electrical, and plumbing, as long as it's for a specific purpose for the building and not necessarily for the building itself. Okay, it has to be for the business. So it gets pretty complicated, and these rules have morphed, like I said, since the 40s. There have been just massive amounts of court cases that give us these rules today. But as an example, something traditional out of today, if you had that same $300,000 single family home, percentage wise, we're going to be able to take, conservatively, I would say about 40% of the cost of that building, or $120,000. Okay. And we're going to be able to shift that into faster class lives for you. So you won't have to depreciate all of it over 27 and a half years, but we can break it out. So essentially what that would be is $180,000 gets depreciated over 27 and a half years, and about $120,000 gets split up between 5 and 15 years. And those are kind of a good rule of thumb numbers to use. Okay. Follow me so far?
I'm with you.
And I have to tell you, I love tax. So I know it's really geeky, but it's okay because I can help you through it. And
That's why people hire you, because
we'll,
you're
we'll get
weird.
excited about it. I also, just to kind of give you an idea, I'm also a real estate investor myself personally. So I
Okay.
have my day job, but I'm also an investor. So I have invested in about 800 doors, multifamily in Texas, and we have cannabis warehouses, and we have a mobile home park, and we have just my husband and I, and we manage them all ourselves, which is pretty incredible. Plus our full-time jobs. But
So,
most people have
and do you
hobbies.
use this? Do you use cost segregation?
Oh, of course. Yeah, I don't do a deal without cost seg. It doesn't matter
Okay.
how big or how small. I do.
And
I will
and
do a
that's the
cost seg.
cool phrase for it is cost seg.
Cost seg, sorry. Yes, short for
All
cost
right,
segregation.
guys, get yourself some cost seg. It's pretty dope. Okay. All right. Um, so explain how your company helps with this, because obviously accountants can't do this. The property manager isn't doing this. The investor doesn't know, when they buy this property. So how do we solve this problem?
Yeah. So, engineer tax services, this is our specialty. This is one of the main service lines that we offer is cost segregation. And this is where I was saying that we do about 150 to 200 studies per month. So across the country, whether it's a single family residence all the way up to something like the AI building in Chicago, okay, a big high rise office building, we do cost segregation and we're very good at it. It's cost effective. A lot of people and most CPAs, I would say that, if it's not over $2 million, then it's going to be too expensive or whatever. We have single family home rates. We have different levels of studies that we can do according to how long you're going to own the property, what you're going to be doing with the property, and those types of things. But maybe we should go in and talk about some numbers, Jason, just to kind of tell everybody, the listeners and the viewers, what it would mean for them.
Well, yeah. So I don't know if this is where you're headed, but if you're saying a lot of people say, oh, well, that's for the big properties. That's too expensive to do for my clients or on these single family homes or on my investment property. What help them justify the cost of doing this study? I'm sure nobody would ever do it with you ever unless it made sense financially.
Yeah. I haven't seen a project that isn't at minimum like a 50-to-1 return.
Okay.
So, I
So
mean,
there
it's
you
going to be
go.
better than any improvement you can do in the house or any tenant changeover or addition or whatever you're going to do. Your returns on this are going to be
And
way
so by
better.
doing this, by getting the cost seg study and working with you guys and with their accountant to make this all happen, what does this allow the investor then to do that they wouldn't have
Well,
been able to do otherwise?
yeah, so they're going to be able to depreciate more in the first years, rather than the 10,900 on the $300,000 property that we talked about. So they're going to
Which
be able
means
to
they're
depreciate
just
more.
reducing their tax liability. They're paying
Hmm.
less in taxes.
Hmm.
Okay.
Yeah,
Which maybe means they have more money to reinvest.
exactly.
Okay.
So, and it's. I want to preface this with the fact that there's a lot of investors that this is passive income for them. And if you don't know whether your income from your investment property is passive or active, you'll want to talk to your CPA because sometimes this gets locked up. And so we're only talking about, if you're a non-real estate professional, kind of how to offset the income from the property so that you're not going to have to pay tax on that. This isn't a
Okay.
loophole. This isn't a loophole. This is nothing that is illegal. This has been around for decades, like he had said. So this isn't something that, oh, I'm going to get in trouble if I do this. This is simply just a different method of accounting. And it requires a professional to come in, just like, an inspector or an appraiser or somebody like that would come in to
Mhm.
tell you, more specifics about a building that you're buying. This is basically more a professional coming in to explain more of, the accounting side of it.
Okay. So what do you call these experts that come out to the property to do a cost seg?
They're engineers.
Engineers.
Yeah,
Okay.
engineers come out. They're either structural professional or mechanical engineers that understand building mechanics and they understand how to break down different components of the building. So that's who we send. And they're our own employees across the country. So they come out to do those studies to document everything. But just keep in mind that the IRS says that if you have a building professional on site, then that is required by the IRS. You can't a CPA can do some sort of cost seg if they're knowledgeable about it, but many of them aren't going to be able to tell you how much the sheetrock costs. And if they do, they're going to just do it from kind of a square foot allocation, and it's not going to be able to stand up in the event of an audit. We offer audit defense, so if the IRS does come back and question this, we're going to cover all of that for you. We're going to defend that for you. Our reports are going to be solid. We're going to be here, and that's what this covers. So we're going to stand behind the product.
Got it. Okay. Yeah. So what else should people know then about cost segregation or about your company that they may ask?
Yeah. So I think we need to talk about tax strategy, okay? Because I think this is really important for people to understand. So many people, and I think in my opinion, too many people don't understand taxes and they let their professional handle it. Just exactly what you said in the very beginning, Jason.
Yeah,
but
that's what I do.
Yeah. And so we have a motto at Engineer Tax Services, and the motto is that we do believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. And that's really what this is.
Yeah.
This is if you're knowledgeable about the tax code and you understand what you are able to do, you will literally put money in your pocket. And so that's what this strategy does. That's what these studies do for you. But you have to know how to use it and when to use it. And that's what I can help with. We help with, realizing when is a good time to do cost seg and when may it not be a good time. When it would not be a good time to do a cost seg study is if it's a flip. Okay, you're gonna buy it, you're gonna renovate it, and you're gonna get rid of it. You will probably not want to accelerate depreciation. It's just not smart because you're essentially taking more depreciation up front because you're going to hold on to those assets like the carpet and you're depreciating it over 5 years, right? So you're not going to get all that money and then keep it if you're going to sell the building, right? So you have to
you don't want to pay for the
consideration.
future owner of the place's carpet.
Right. So I would say if you're unless you're doing substantial rehab, now that's a different story. And if you're going to actually depreciate the property on a flip, you usually don't depreciate it because you're never placing it in service. If that makes sense, you're never really putting it in service because it's all going to be under renovation. So you're not going to depreciate it and that kind of thing. So this does not include flippers, but it does include people who are renting their property. If you have this passive income, so let's just take our $300,000 example from the beginning, and you're getting the $10,900 in depreciation every year. If your cash flow is bigger than that, more than that, and you're still paying some tax on that income, and you might have to figure that out because you might have a job in your W-2 and you're not really sure what part of this is what you owed in tax because of the house and the income and what's on your W-2. So it's really important for you to kind of see where this is coming from. How much am I paying tax on from my rental property? Ask those questions to your CPA. Or we can work with you on that if we're looking at tax returns and kind of help you there. So that's the first thing, is really just kind of ask some questions. If it doesn't make sense, let's make it make sense. Let's make sure that the common sense is there, so at least that it kind of triggers certain things in the brain. When you get into that and you start realizing that you are paying tax on that income and that $10,000 isn't enough, then you're going to want to do some sort of cost segregation so that you can accelerate the depreciation faster, especially if you're going to do renovations. Because many times we buy property and then we're doing renovations either immediately or there soon after, or even just repairs and maintenance, and we have to capitalize that in many cases. So now you're actually depreciating two assets. So let's say you buy a building and you bought a building and it had a roof, okay? And then the roof gets replaced in 5 years. Now you're required to, you can't write off the roof. You have to capitalize it, which means you have to depreciate it. You don't just get an expense for the cost of the roof. Okay, so you have to capitalize it and depreciate it. And now you have two roofs. You're depreciating one in the purchase and you're depreciating one that you just bought. Well, that's where we really want to come back from that and say, I don't want to depreciate two roofs, because when I sell this property, I'm going to get killed on the accumulated appreciation on both those assets. I only have one in the building. Why am I depreciating two? So really, if you do a cost save study on the original purchase and then you replace the roof, not only do you have to capitalize the new roof, but you can write off the remaining depreciation of the old roof. Now, traditionally, your
Okay.
CPAs can't do that because they don't know how to value the roof if you don't have a cost segregation study. Okay.
Right.
So not only are you going to help you with your depreciation, but you're now going to have a very detailed fixed asset report that's going to outline every single aspect, every component of that building, and it's going to have a number attached to it. Every light switch plate cover on the wall, every baseboard, every layer of the roof, HVAC system, hot water heater. So now you have this really great report that every time you do any improvements that have to be capitalized, you get to write off the remaining depreciation of the old. And so let's think about this for a minute. Let's say you buy a property and you have it for 3 years and the hot water heater goes out, and it's a significant dollar amount and you have to replace it. You can now take that hot water heater, if it's not expensible, you capitalize it and you write off the old hot water heater. And if you had it on a straight line depreciation, that water heater is being depreciated over 27 and a half years. So that means you're going to have, how many years is year 3? So you have 24 years left, 24 and a half years left of depreciation on the old one. So now you're depreciating two of them. Why not get that money right now and help cover the cost of the new water heater? That's the beauty of cost segregation.
Nice. Okay. So now you had mentioned real estate agents. Are they not allowed to do cost segregation on their properties if they're an agent?
No, it actually gets better for them. So if you're a real estate professional, there's a whole different conversation. Okay. So what we've been talking,
a lot of our listeners, they're property management business owners, but they're also brokers, real estate agents, and are licensed. Most of them.
Yeah, and that's where we want to get into. And this is part of the tax strategy that I was talking about. If you are a real estate professional in any capacity, whether you're self-proclaimed real estate professional and you're managing your own property, or if you're actually a real estate professional, an agent or a manager, if you are paying tax, if you're a W-2 employee, whatever, or if it's a 1099, if you're paying tax, and you're a real estate professional, you have had some misinformation. This industry right now, we have a real estate president. Like him or hate him, it doesn't matter, but he is a real estate president, and he walked in and just literally handed the real estate industry a gift with a big red bow. And it's called bonus depreciation. Okay. So what this means is that, remember when we said the 300,000 and you'd have, over 27 and a half years, you'd have $10,900. Then if we did a cost segregation, we would be able to accelerate some depreciation, and that would be a little bit better. It would be a lot better, actually. But now with the new 2018, this is the Tax Cuts and Jobs Act, of 2018, just recently. President Trump passed the bill for bonus depreciation. Now, let me go back a little bit in history. Bonus depreciation has been around since 2006. It was 50% bonus depreciation, and I'll cover what that 50% of what in a minute. But 50% bonus depreciation on new construction or renovations. Okay, so you're essentially able to really expense a lot of stuff to a certain point, at least half of it, for a long time, from 2006 until through 2017. In 2018, President Trump passed in this Tax Cuts and Jobs Act, not only increasing the bonus depreciation to 100% from 50, but they also expanded it to allow purchases, not just new construction. Okay. What this means is that, say you're a real estate professional, let's say you're making $200,000 a year. Okay. Maybe it's tons more, but let's just call it that. Let's say you're making $200,000 a year. And at that level, you're probably paying 33% tax rate, something like that. Right. Maybe a little bit less, that state, whatever. Let's just call it 35% just to be generous. Okay. So each year you're paying about $70,000 in taxes, income taxes.
Mm-hmm.
So if you are a real estate professional and you go buy a property, let's just say you go buy this $300,000 house and you're going to start renting it out. Okay.
All
Now
right.
we have the cash flow. Great. We have the income from that, which is also a factor, but let's just talk about the tax for a minute. When and if you do buy a $300,000 property and you're a real estate professional and you do a cost seg study on that building, essentially we're going to be able to write off about 40% of it. That's $120,000. Now, normally, if you're not a real estate professional, that's locked up on your passive income and it cannot offset your W-2 wages. It has to just stick with the income from the property or other properties that you own. Okay. So if it goes on your Schedule E, it could be if you own 10 properties, then that $120,000 will house all the other properties, but it is still stuck on the passive side because it's passive income. When you're a real estate professional, it's active income. And so this is active depreciation, which is also covers all of your regular W-2 or 1099 income when you're in the real estate industry. So what that means, the bonus depreciation says, now remember when I said that the 120,000 would be shifted over 5 or 15 years. Okay, so we'd have to prorate that all out over those buckets. But what's really cool about bonus depreciation is that means that 100%, okay, not 50 anymore, and on purchases, but 100% of your purchase price that is allocated to a class life less than 20 years. Okay, so when you heard me talk about the 5-year buckets and the 15-year buckets, anything in a cost seg study that you reclassify that's less than 20 years, which would be about 40% of this building, you get to take as a write-off in year 1.
Really?
Yeah. So now you get this $120,000 in the year that you purchased it. You can go buy a property on December 31st and it closed before the end of the year, and you can offset your taxes by the amount of your results of your cost seg study. So in this case, $120,000, okay, that you get to offset of your $200,000. So you made $200,000. You're going to depreciate $120,000. Now you're only paying tax on $80,000. But if you buy 2 houses, you basically just wrote off, and you get to pocket that $70,000 that you would have paid in taxes. Now let's just run the numbers real quick. If you have $300,000 and you're saying you're going to put 30% down, that's $90,000. But you just offset, let's just say the 120,000 times the tax rate of 33%, so 40,000. So basically what that $120,000 would equate to is about $40,000 in cash. So instead of coming up with your down payment of 30%, so that was 40. Okay. So if you had to come up with 30%, you're at, well, I'm just reading the numbers. So you got to come up with a $90,000 down payment to buy that $300,000 house, but you're going to get $40,000 back in your pocket immediately, like as soon as you file your tax return. Okay. So you get to write that off. So buy 2 properties and you just wiped out your entire tax liability for the year.
Okay. This sounds almost too good to be true, what you're saying. So, but help me understand, how many agents do you think are doing this type of stuff, but they're not doing cost seg and they're just leaving tens or hundreds of thousands of dollars on the table?
Probably 80 to 90%.
So this is a pretty big problem.
Well, that's why I'm on the shows, because I want to raise the awareness. I will tell you personally, like I'm an executive, my husband's an executive, we have high incomes. And when they came out with this bill, the first thing that I told my husband was, we have to go buy some property. So I am a real estate professional by trade just because of what I do anyway. So I'm a professional. So we are under contract to buy a mobile home park, and we're closing on December 31st. Not just so, but we have good income and I bought it right. But I actually am going to have, about a $400,000 or $500,000 write-off this year for my taxes.
Nice. Well, so is there anything else that people need to know about this? Because that was a really good point. Any other major things that they should be aware of?
Yeah. So bonus depreciation goes through 2026.
Okay.
So you can buy.
And then what happens?
Well, then it starts to phase out. Starting in 2023, it goes from 100% to 80%. Then 2024, it goes down to 60%. And then 2025, it goes to 40%. And then in 2026, there's only 20% bonus depreciation. Now, it doesn't
So
mean cost seg is not beneficial. It's still beneficial to do that, just like it would have been without bonus depreciation. But there's a greater incentive to do it now. And this is all brand new tax rules that just came out in 2018. So if you're saying to yourself, hey, well, I haven't heard of this has got to be a scam, it's not. This is a big deal, and it's
it's a big deal.
huge for
So was
President
this
Trump to be
done
able
to
to do this for.
basically spark the economy? Is that why they're throwing this out there? It's such a big, booby prize, so to speak, and then they're going to start they're depreciating bonus depreciation over time. They're going to be taking it down. But is that kind of the mindset of why it was put out there?
Yeah, so I'm on the tax committee for the Real Estate Roundtable in Washington, D.C.
Uh-huh.
And when the Tax Cuts and Jobs Act was being formulated, we had long discussions about how to deal with depreciation and what to do. And everyone was worried about the real estate kind of being in the seventh or eighth inning, right? As far as a cycle goes. And hey, we're a little bit worried about this. How can it continue to be sustainable at these rates? And so, the big talk of this Tax Cuts and Jobs Act on President Trump's docket was solely to raise the GDP and just really get the economy going a little bit better. Yeah. And so what they did to incentivize that is to offer this bonus depreciation. And so this was part of that incentive to buy property, exchange property. They also, in this package, was part of the opportunity zone, which I know a lot about. If you don't know about that, we can do a whole nother show on that. About purchasing property in an opportunity zone and then having essentially no tax liability on that after you've held it for 10 years, as long as you do some improvements.
Okay.
So that's a whole nother show that we could do. But
sure.
All of this was part of the Tax Cuts and Jobs Act, and it was very powerful. And in my opinion, I think we probably at that time went from a seventh or eighth inning in real estate back down to maybe the fifth or sixth inning. And that's what has really continued to boost and postpone any kind of real estate downturn.
So few are aware. Who is aware of this and is capitalizing on this? I mean, obviously your company and your clients, but who's been taking advantage of this?
We do a really good job educating CPAs across the country. Well, we try, but there are a lot of CPAs out there. We cannot touch them all. I mean, we've got 120 people and there's literally hundreds of thousands of CPAs. So we do the best we can. We love CPAs. We want to educate them. We want to be connected with them. So if you are not doing this and you want to do this, it would be great for us to work together, but I really want to talk to your CPA because he has more views out there that I want to make sure that he's aware and give him or her resources to be able to let other people know that we do this. We do this very economically. Okay. So clients would be, I work with a lot of property management companies, investors, funds. I work with a lot of family offices. I work with a lot of individuals. The word is now starting to get out there. And so there's a lot more individuals that are starting. We do a lot of shows like this to bring what really the wealthy has done for a long time and down into mainstream. And that's really what we've been doing.
Random side question is, so if property managers came to you and they've got lots of investors, is there some sort of service that they could work with on you that they could add as a new revenue stream to push their investors towards you?
Yeah, absolutely. Have them call us because we can do some sort of, fee share or something like that, or just a finder's fee or something like that. And property managers, historically it's been difficult because property managers do the property management and they usually don't get involved in the taxes. And so it's hard for them to have those discussions because a lot of times with the owner, they'll say, hey, you should really do cost seg. And they're going to go, oh, it's taxes. My CPA handles that. Right. So now you're dealing with two different layers
Yeah.
And just like what you said at the beginning, is anything having to do with tax, I'll let my CPA do,
Mm-hmm.
right? Most people have that mentality. You're like, oh, I'm sure my CPA is already doing this if it's that big. But I'm telling you, please listen to me. Most CPAs are not doing this.
Right.
I'm telling you that right now, most of them aren't. So be proactive. Take your own taxes and your knowledge into your own hands and ask the appropriate questions. I will tell you, I will leave you with a kind of a case study of a project I'm working on right now. This is
Okay.
incredible. I literally have a client that I was referred to from a CPA. So the CPA brought me the client, very good CPA client of mine, brought me this client. He owns tons of property all over the country. His family owns property, and I've done all their cost segs for about 5 or 6 years. And we finished a project, and I was on my closing call with him explaining the study and the last report and everything. And he says to me, I'm part owner in this mobile home park. And I think we should probably do this. Do you think it'd be worth it? And I said, absolutely. Mobile home parks are a killer. They're amazing. They do way better than single family homes, or multifamily for that matter. And I said,
Mm-hmm.
yes, it's absolutely worth it. Get me the depreciation schedule, and we'll go over it. So he put his partner on the phone with me, and we talked about it. And then they finally sent me the depreciation schedule. The mobile home park was put on their depreciation schedule as land, $3.5 million as land.
Okay.
And I said, I looked at that, and I it almost gasped at me. And I called him, I was like, oh, that's not good. You're not depreciating this at all. Land is not depreciable. So it's like you just bought a raw piece of land. He goes, well, that's just all there is. We don't own any of the parks. I go, yeah, but you own the pads and the electrical posts, and you own a laundry facility, and there's a house on there, and there's fencing, and there's all kinds of stuff that are land improvements. That's all 15-year depreciation. So you have to pull out the land first and then depreciate what's left. And he goes,
Mm-hmm.
oh man. Okay, so long story short, we get on the phone with the CPA, and they're like, why didn't you depreciate this? Why is it all in land? He's like, oh well, I didn't know.
Yeah.
Right? So the CPAs don't know this stuff. So make sure that you're asking questions. If you have even just an inkling, just reach out to me. I try to be very responsive on my emails and text messages and whatnot, but email me. It's Lochridge, and it's LOCHRIDGE at engineeredtaxservices.com. Shoot me an email, and I'll just, give me some synopsis of what's going on. I'll send me your depreciation schedule, and I'll be able to tell you really quick whether we can do something or not. But most CPAs are not doing this because they don't have the resources. They don't even know. Like, how is a CPA to know how much the electrical posts were going to be to depreciate? How is he supposed to
Yeah, they
know how
don't.
much the pads are? They don't. So you have to have a professional go out there. Appraisers can't do it because they're going to tell you what's in there and what the total value is, but they're not going to break it down. Inspectors are going to tell you what's wrong, right? But nobody's going to tell you what the cost of every component is in that building. So that's where the power comes.
Awesome. All right. This is really interesting to me. So I appreciate you coming on the show, Kim.
Yeah.
And you gave out your email address, which we will have in the show notes as well and on the website. How else can they get in touch with your company?
Our website is engineeredtaxservices.com. I'm also, on the back page for our team. Just pick my profile and shoot me an email from there as well. I'm happy to help you. I have an assistant that can handle all the influx of emails that might come. So we'll be able to work through them all. But I'd love to hear from you, and please just reach out so we can at least talk tax.
Perfect. Kim, thanks for coming out and hanging out with me here on the DoorGrow Show.
Anytime.
All right, we'll let you go.
Okay,
Bye.
we'll talk soon. Bye, Jason.
All right, so there you have it. Really interesting topic, and I didn't know about that. So really fascinating. I'm sure it might be new to a lot of you. So if that was helpful, make sure to reach out to them. And if you are watching this on YouTube, make sure to subscribe and catch these videos as they come out. And if you are paying attention to us on iTunes and listening, make sure to subscribe on iTunes. And if you can, give us a little review, like this video, whatever you can do to help us out. It means a lot. We're putting out a lot of free content. We would love it if you'd reciprocate just a little bit and help us out. It helps us get the message out. It helps us get greater awareness and help more property managers and change this industry. So I'm Jason Hull with DoorGrow, and we are headed now. This is right towards the end of the year. This may come out actually in 2020 on iTunes and other places, but To everybody, happy holidays. I hope you have a fantastic 2020. If you're looking to grow your business and you're wanting a vision for 2020, you want 2020 vision, and you're looking to have a plan and you want to do something different, reach out to DoorGrow. I'll say this real quick. If you didn't get the results that you wanted in 2019, or the results that you wanted in 2018, or in 2017, you know exactly where you're going to be at the end of 2020. You're going to be at the same level of results you've had every year so far. That's your default future. If you want to have a created future that's dramatically different, then I would love and be honored to help you create that. We've helped hundreds of companies do that. Those that listen to me and follow and do what I told them to do and show up to our coaching calls and show up, they get those results. They get it. And I would love that to be you. So that's it. Bye, everyone. Until next time, to our mutual growth.